Hey folks, tonight we're diving into the murky waters of taxation, specifically the flat tax. It's a system that sounds deceptively simple, one tax rate for everyone regardless of income. But like a bathtub full of eels, it's more complicated than it appears. Let's unpack this, shall we? Imagine a world without those convoluted tax forms. A world where everyone pays the same percentage of their income. Sounds utopian, right? Well, hold your horses, because the flat tax comes with its own set of baggage. Is it a magic bullet for economic woes or a recipe for social disparity? Stick around as we break down the flat tax conundrum. So, what is a flat tax exactly? It's a tax system where everyone pays the same percentage of their income irrespective of how much they earn. Imagine a world where a billionaire and a barista both pay, say, 15% of their income in taxes. Proponents argue that this creates a level playing field, eliminating the need for complex deductions and loopholes. They say it encourages economic growth by leaving more money in people's pockets and simplifying the tax process for businesses. But critics argue that this simplicity comes at a cost. They say it disproportionately benefits the wealthy, as a flat rate takes a smaller chunk from higher earners. Additionally, they argue it could lead to a decrease in government revenue, impacting social programs. One of the biggest selling points of a flat tax is its simplicity. No more navigating a labyrinthine tax code or hiring expensive accountants. It's easy to understand, making tax season less of a headache for individuals and businesses. This simplicity also fosters transparency. With a single tax rate, it's easier to see where your money is going and how it's being used by the government. This transparency can increase accountability and reduce the potential for corruption. Furthermore, proponents argue that a flat tax is inherently fairer than a progressive system. They argue that everyone contributing the same percentage of their income fosters a sense of shared responsibility and eliminates the disincentive for high earners to work more. Section 4. Cons of a flat tax: inequality and revenue shortfalls. Critics argue that the seeming fairness of a flat tax is an illusion. They point out that a flat rate disproportionately benefits the wealthy. A 15% tax on a millionaire's income is a much smaller sacrifice than a 15% tax on a minimum wage worker's earnings. This could exacerbate income inequality, creating a wider gap between the rich and the poor. Additionally, opponents argue that a flat tax could lead to a decrease in government revenue, as those at the top of the income ladder would pay a smaller percentage of their income in taxes. This could lead to cuts in essential public services like healthcare, education, and infrastructure, disproportionately impacting those who rely on these services the most. Section 5. Conclusion: weighing the merits and demerits. So, is a flat tax a magic bullet or a recipe for disaster? Like most things in life, the answer is nuanced. It offers the allure of simplicity and transparency, but carries the risk of exacerbating inequality and reducing government revenue. The potential impact on different income groups is a key point of contention. While it might seem fairer on the surface, critics argue that it could disproportionately benefit the wealthy at the expense of the poor. Ultimately, the decision of whether or not to implement a flat tax is a complex one, with far-reaching social and economic implications. And on that cheerful note, we'll leave you to ponder the intricacies of taxation. Good night. Good.